This video is an inside-the-wall research memo providing a post-earnings analysis of Oracle Corporation's Q2 fiscal year 2026 results. We will explore why the stock fell sharply despite strong AI indicators following the December 11, 2025 report. The headlines were strong, driven by accelerating cloud and AI infrastructure demand. Remaining performance obligations, or RPO, surged 433% year-over-year. However, the stock declined 12 to 15%. The narrative shifted to a capital-heavy infrastructure build-out, with deep negative free cash flow and rising capital expenditure reshaping the equity risk profile. Post-earnings, Oracle shares erased $70 to $100 billion plus in market value. This sharp decline reflects systemic concerns around AI infrastructure economics. The market effectively re-rated Oracle, penalizing the sudden spike in capital intensity required to service its massive backlog. Looking at the Q2 fiscal year 2026 financial highlights, total revenue was $16.1 billion, slightly below consensus. Cloud revenue showed strong growth at $8 billion, while OCI infrastructure accelerated to $4.1 billion. Crucially, RPO, the record pipeline backlog, reached $523.3 billion, a 433% year-over-year increase. The cost of competing in AI infrastructure is escalating. Q2 capital expenditure, or CapEx, hit $12 billion, above the expected $8 billion. Furthermore, FY2026 CapEx guidance was raised by $15 billion to a massive $50 billion total. This implies a multi-year cycle of heavy investment to build capacity for future demand. The aggressive CapEx ramp resulted in deep negative free cash flow of $10 billion for Q2. This liquidity strain raises concerns about reliance on external financing. Moody's has also shifted Oracle's credit outlook to negative, citing rising leverage above $100 billion. The backlog presents a paradox. The record RPO of $523 billion signals massive future contractual revenue. However, conversion is lagging, with FY26 revenue guidance unchanged. The conversion velocity from contract to revenue is slower than the market anticipated. Reported EPS of $2.26 beat expectations, but was significantly boosted by a one-time gain, suggesting weaker core earnings. Operating margins are trending down due to the mix shift towards lower-margin infrastructure revenue. Legacy software revenues also declined by about 21%. The Q3 guidance outlook shows solid growth numbers, including 37 to 41% cloud revenue growth. However, this was insufficient to offset investor panic regarding capital intensity and cash flow burn. The market interpretation has a bull case focused on unmatched AI demand, differentiated AI platform, and RPO validating long-term share gain. The bear case highlights the massive CapEx hole, rising leverage risk, and an equity re-rating to low-margin infrastructure. Ultimately, it was a good quarter for AI demand, but negative for equity risk-adjusted returns. The stock decline reflects a rational repricing. High demand is undeniable, but it is being funded through leverage and deep negative free cash flow with a delayed payoff timeline. Thank you for watching this analysis. Please leave a comment with any questions or thoughts on the video.